Welcome to the deep dive. We've just come up from a session with our research team going through this stack of high alert financial analyses. They're all dated mid-December 2025.
And the consensus is, well, it's pretty chilling.
It really is. We are not just looking at a run-of-the-mill market correction. The sources are tracking a synchronized, sort of mechanical failure of the system.
They're calling it the accelerated risk economy.
Right. So our mission today for you was to pull out the most alarming points. We're talking a guaranteed crash scenario and the threat of uncontrolled inflation.
But more than that, we need to translate what these really complex failures mean for your daily life, from housing costs to just the stability of your money.
And what we found really paints two pictures of immediate systemic risk.
That's right. First, you've got the immediate short-term thing, a crash event centered on the crypto and tech complex. It's driven by almost physics-like feedback loops and leverage.
And then there's the bigger structural threat.
A long-term erosion of the U.S. dollar stability, basically enabled by this massive unregulated growth of the shadow money ecosystem.
And both issues boil down to a loss of central control.
Critically lost, yeah.
Okay, let's unpack this. We have to start with the market's guaranteed crash. The sources analyze the entire financial system like it's a single overloaded electrical circuit.
And it began to fail decisively around December 16th, 2025.
So this isn't economics, it's thermodynamics.
Exactly. You have to think in terms of mechanical stress. The second the system overloaded, three critical components immediately went into distress.
Okay, so the first one, which they call the reactor, that's the volatility source, right?
Yeah.
MicroStrategy and crypto.
Right, and its state is meltdown. The indicator was Bitcoin breaching that critical $86,000 support level.
And that just instantly collapses the entire valuation narrative, the MSTR premium everyone's talking about.
Poof, gone. And that failure immediately sends stress to the second component, the thermal battery.
This is where all the risk was being stored. Private equity, private credit.
And its state is now frozen. Lenders suddenly realized the collateral backing their loans, GPUs, Bitcoin miners, is losing value in real time.
Which means panic.
Total panic. High-yield spreads widen violently. It's a complete fear signal.
So if the thermal battery is freezing up, then the third part, the high-load device, has to start selling off assets.
That's the whole AI, CapEx, boom your NVIDIAs of the world. Its state is liquidation.
And they're not just selling, they're using these stocks as ATMs, right, to cover margin calls from the crypto failure.
Exactly. But what's fascinating and kind of terrifying is that the sources say this isn't just normal market fear.
This is engineered, the Doomsday Machine.
It's an algorithmic mechanism. I mean, the crucial math is that that's the reverse flywheel. A Bitcoin crash makes MSTR's assets drop, which tanks the stock price. That drop triggers panic, which pushes Bitcoin even lower. It's a no-break spiral.
But the truly mechanical, the most alarming part is what they call the gamma nuclear reaction. This is the artificial selling pressure.
And it revolves around billions in put options expiring on December 19th.
Okay, so explain why this isn't just about bearish investors.
Because it's a mathematical certainty, not a choice. When MSTR stock drops below certain prices, say 160, 150, 140, the market makers who sold those puts.
The ones who sold the downside protection.
Yes. They are mathematically forced to hedge their position. And how do they do that? By short selling the stock immediately.
So it creates this vacuum of forced selling that just accelerates the crash, no matter what the company's fundamentals are.
It's purely derivatives mechanics.
So for you listening at home, what does this chain of events mean outside of crypto? The shock spreads instantly, right?
Yeah.
Asian markets dump.
The initial impact is a liquidity shock, yes. But the real danger isn't the Bitcoin price. The real danger is the credit freeze that follows.
Lenders get scared. They stop rolling over debt for smaller companies, the Russell 2000.
And this is what the sources call the zombie flush.
That sounds dramatic. What does it actually mean for the Main Street economy?
It means all those companies that were relying on cheap, continuously rolled over credit just to stay alive, the zombie companies, they face immediate insolvency.
Wow.
If lenders freeze up, construction halts, inventory financing evaporates, projects just stop. That's how a complex failure in the derivatives market turns into job losses in your local economy.
It just kills that whole soft landing narrative dead.
Instantly.
So that's the short-term crash. But the reports also dig into the long-term structural flaws, specifically with MicroStrategy, using the same thermodynamic laws.
Right, we're moving from an acute failure to a chronic instability. They define MSTR's core internal problem as the entropy trap.
Which is just sheer dilution.
Exactly. Their whole infinite money glitch strategy issues stock to buy Bitcoin, which raises the stock price. It only works if the new money coming in, the energy input, exceeds the entropy.
Which is the dilution of existing shares.
Yeah.
And the data shows entropy is winning, right?
By a lot. Shares outstanding nearly doubled in less than 2 years, from about 158 million to 296 million.
So for the listener, that means every share you own represents less underlying Bitcoin over time.
That's the silent killer, the friction that undermines the whole perpetual motion machine, especially when Bitcoin's price starts falling. The system is just inherently unstable.
And this leads directly to this huge pre-scheduled regulatory event, the phase transition, on January 15, 2026.
The MSCI index decision, it's crucial. MSCI, which runs these massive global indexes, is deciding if MSTR needs to be reclassified.
Because its digital assets are now over 50% of its total assets.
Right. And if they reclassify it as a crypto vehicle, the consequences are immediate and severe.
But why does a decision by MSCI matter to someone who doesn't even invest in their indexes?
Because billions of dollars in passive funds, retirement funds, ETFs, they have to track that index. If MSTR gets removed, those fund managers are forced to sell instantly.
And the premium to net asset value?
Evaporates entirely. The premium MSTR stock trades at above the value of its Bitcoin, just vanishes.
So it goes from, say, 1.1 times the value of its Bitcoin down to 1.0, or even lower.
Precisely. That's a potential 10 to 20% drop right there. On top of the crash we already talked about, it's a pre-scheduled time bomb.
Let's talk about the absolute worst-case scenario they lay out, the supercritical failure.
This happens if two things happen at once. Bitcoin drops below $80,000, and MSCI announces the exclusion.
Okay.
This triggers what they call forced venting. MSTR can't issue new shares in a crashing market, so to pay its bondholders, it's forced to start selling its actual Bitcoin.
And that's the ultimate feedback loop. MSTR sells 10,000 Bitcoin, which drives the price down, which triggers more margin calls.
Forcing them to sell even more. It's a catastrophic spiral. And here's the kicker. Because big traders treat MSTR as a proxy for the tech sector, this ensures the contagion spreads, pulling down correlated stocks like Nvidia and Tesla right along with it.
Okay, here's where it gets really interesting. Let's switch from market instability to currency stability. If all this is shaking confidence in assets, what does it do to the bedrock of the system, the US dollar?
Well, the reports describe the severe tug-of-war in late 2025, where crypto is playing a dual role. On one hand, it's a liquidity sponge.
Meaning it's soaking up excess cash.
Exactly. The M2 money supply is at a record high, $22.3 trillion. The $3 trillion crypto market absorbs a lot of that excess capital, which might actually be dampening inflation.
It's taking cash out of the system that would otherwise be bidding up the price of, eggs and milk.
But that cash isn't gone, it's just stored. And that's the leakage risk.
If confidence wavers, that $3 trillion in stored purchasing power could flood back into the real economy.
Instantly. It turns into cash chasing a limited supply of goods and services. That is textbook demand pull inflation.
And the sources are very specific about how this happens. Vector 1, the alarming wealth effect transmission.
This is crucial for you to understand. Studies confirm that the marginal propensity to consume, how much of a gain you actually spend, is literally double for crypto wealth compared to stock market gains.
So if I sell some of my boring mutual fund, I might save the money. But if I cash out my crypto,
you're much more likely to immediately buy something big. It's that found money or lottery effect they talk about.
you treat it like a windfall, yeah.
And this isn't just about luxury cars. It's affecting your biggest personal expense, housing.
The real estate spillover.
The reports quantify it. They found that an additional dollar of per capita retail crypto wealth increases county-level house prices by about 15 cents over the next 3 months.
Wait, 15 cents for every extra dollar of crypto wealth in a community? That's a direct, measurable inflation vector into the housing market.
Which is a third of the entire CPI basket we use to measure inflation. It's the most direct path from a speculative asset to your everyday cost of living.
Okay, what about vector 2? the shadow banking multiplier.
This is about the rise of stablecoins and DeFi, creating a parallel, unregulated banking system completely outside the Fed's control.
The U.S. tried to get a handle on this with the Genius Act of 2025, right? Forcing them to have one-to-one reserves.
That was the idea, but the sources found a critical shadow yield loophole. The act didn't ban affiliates of stablecoin issuers from offering rewards or yield.
So money just flows from an insured bank deposit paying 0.5% to an uninsured stablecoin offering 5, 6, 7%.
Precisely. This capital flight forces traditional banks to raise their own deposit rates just to keep customers. That increases the cost of capital for everyone, creating this systemic cost-push inflation.
And the Fed can't really control it because it's happening outside their regulatory perimeter.
It's like the financial system is building its own parallel universe. The sources draw a chilling euro-dollar parallel,
Stablecoins are the new on-chain dollars.
mirroring the euro-dollar market of the 20th century. A massive global credit system outside U.S. control, projected to hit $1 to $3 trillion. The systemic fragility is centered on the bailout alarm.
What happens if there's a run on stablecoins?
A simultaneous run could force a fire sale of hundreds of billions in U.S. treasuries held as reserves. That would destabilize the entire U.S. debt market.
Forcing the Fed to step in as the buyer of last resort.
And expanding its balance sheet to do so. That is, by definition, inflationary. The 2008 analogy with the reserve primary fund breaking the buck is key.
The government stepped in to backstop that one fund.
Right. But today, if Tether or Circle break the buck, the Fed might be forced to backstop the entire, maybe $3 trillion stablecoin market. That injection of new money would be the ultimate inflationary event you need to fear.
Okay, let's get to the most dangerous long-term scenario. The fiscal theory of the price level, or FTPL.
This connects everything, the market volatility, the shadow money, to the reality of U.S. debt.
Which is now over $37 trillion.
The theory is simple. If the public loses faith that the government can ever pay its bills, the value of the currency itself just devalues instantly to match that lost credibility.
So inflation jumps to balance the government's budget.
Precisely. And this is where crypto is the terrifying accelerant. Historically, moving money out of a fiat currency was slow and difficult.
But now crypto provides a frictionless 247 exit ramp.
Yes. You can move millions from a bank to Bitcoin in minutes. This capital flight velocity can turn moderate inflation into a hyperinflationary spiral almost instantly. It makes the Fed's interest rate tools totally impotent.
So what does this all mean?
The core finding is that cryptocurrencies act as a powerful accelerant for existing imbalances. They remove the friction that used to protect sovereign currencies from rapid capital flight.
So in a stable fiscal environment, they're manageable. But in an unstable one.
They're the catalyst for an uncontrolled spiral.
And we have to acknowledge this huge paradox happening right now. The sources mentioned that global adoption of USD stablecoins is actually a positive for the U.S. consumer.
It is. It creates huge offshore demand for dollars, strengthening the dollar and making imports cheaper. It's a deflationary force for now.
A critical but temporary advantage.
Right.
But the existential question they pose is, what happens if a geopolitical rival launches a competing non-USD stablecoin that actually gains traction? If that huge offshore float of digital dollars comes crashing back on shore.
The sources suggest the U.S. could face a catastrophic inflationary spike. They call it the Triffin Dilemma 2.0.
That fight for the global digital reserve currency, that's the next pressure point to watch.
Absolutely. The system is operating without its historical safety mechanisms. We're just waiting to see which lever breaks first.
Thank you for joining us for this deep dive.